Marc Ostwald. Are you there, Marc?
I am.
Great, Marc. First of all, let's start with the markets. I was wondering what's driving the optimism today, both in Europe and the United States. If we take a look at the futures, all of them are way higher.
Well, I think the trend in recent weeks has been very clear, and that is whatever the trend is during the week, well, Friday, what we see is a lot of book squaring going on. So I think part of this is because we've had the volatility, we've had quite a few down days this week, and we are picking things up. That said, obviously the economic data that we've had today has been very encouraging. It doesn't really matter where you look. The UK and the Eurozone PMIs were good. The UK retail sales numbers even stronger than people had been expected, and that was only with basically half a month of coming out of lockdown. So I think that that's definitely helping matters, but we are in what I would call a more volatile period, simply because the more optimistic the economic numbers are, the more likely that people then have to revisit this discussion, whether it's about the Eurozone and the ECB or with the Fed, about whether they might need to actually start tapering earlier than they're actually indicating. So that's essentially what drives the volatility. Good news is effectively both good and bad.
So let's move to the economic calendar. As you said, I just wanted to show everybody, of course, this is European data market manufacturing PMI at 62.8 versus 62.5 estimates. Then, of course, we got also PMI flash services 55.1 versus 52.3. So this is a little bit delusional, but as I said, a little bit keyword. And of course, let's take a very quick check on the UK data. Market CIPC UK services PMI flash is 61.8, and then composite PMI flash for May 62 versus expectations of 62, together with the manufacturing at 66.1 versus 16.5 of expectations. So Marc, can we say that the UK economy roars out of lockdown?
Well, certainly the services side is picking up. The manufacturing is a global phenomenon, but within the manufacturing data, and indeed if you look at the services data, what we do see plenty of evidence of is a lot of price pressures emerging, price pressures being passed through in a lot of cases. And we also see a massive extension. The German manufacturing PMI delivery times index, I think, is at the worst levels, i.e. the most lengthy delivery times that one can think of. And if people have a good read across to the logistics managers index in the US, really where this problem with supply chains is coming from is the fact that a lot of the companies which are involved in transport and warehousing basically do not want to up capacity because they see this as pent-up demand, and if they expand their capacity, they believe that, say, in 6 or 12 months' time, they're effectively going to be left holding the baby, i.e. they expand capacity, but the momentum that we have at the moment, a lot of which is pent up, a lot of which is due to prior lack of demand, will fizzle out. So there is a problem here, and I think the biggest problem of all is how many of these price pressures are actually going to stick, because if there's no expansion of capacity, that basically means that prices are going to be pressured all round.
And of course, after the macro data, we were wondering, do you expect that central banks were going to taper before, of course, the initial deadline?
I think
and moreover, is it necessary at this point, after we saw the Eurozone inflation and, of course, the US inflation that we've discussed already?
Yes, I mean, I think if we look at the inflation data, to be honest, if we look at core inflation numbers across the world, even in the United States, you know, if you take out the autos, second-hand cars part, actually it's probably not a lot higher than it was last year, just before in February. Certainly Eurozone, Canada, we've had inflation data from. So there is going to be further pickups, but the central banks for the time being, and certainly while we've got these very adverse base effects, which we will have throughout Q2, they will say, well, we can look through this. The real testing point comes in the second half of the year to see how many of the current price pressures stick. And I think that's where the greater risk is, and the pressure will continue to mount. I don't think markets will have a lot of patience for the like in July, like a lot of these price pressures are sticking, and particularly if the momentum in these economies is still quite good. Now, my question really is say with the UK, for example, just taking one is going to fizzle out, because that's really the key test.
We've lost a few lines, but I was wondering, what's your take on the bond yield, specifically in Italy? You remember last week I was talking about it once again, but throughout this week we saw the 10-year Italian BDP at 1.13, currently at 1.01, still above the 1%, which is quite important. Then we have the spread between the BDP and the Bund at 113 basis points today, but yesterday at 1.23. So I was wondering, how do you interpret this all of a sudden increase of BDP yields and I shall say European bond yields, not only Italian?
Yes, I mean, it's been, there's an underlying thing with the German Bund yield at minus 0.1 roughly. The upward pressure is there, and it has to do with the fact that actually a lot of people are looking at the ECB and thinking, well, there's probably more hawks on the ECB, and there's going to be a narrative problem here. So, and with the huge amount of extra borrowing that's going on in Italy, we've had further supplementary budget measures announced. It's understandable that if we see the risk that the ECB starts to backpedal on its QE purchases, and I think for a lot of people actually the increases in the ECB purchases have not really impressed them that much. So you've got a combination of factors here: better economic data, an upward creep in prices, prospects of the numbers out of Europe particularly. There's still a lot of catch-up to be done in the services side relative to the US and the UK. And if we see those price pressures mounting and the demand mounting, then people will be saying, well, at the end of the day, it's going to be very difficult for the ECB not to acknowledge that perhaps it does need to wind back that. And the moment we start seeing any of the support, even the hint of it, being withdrawn, so there will be a problem.
That's for sure. Mark, I'd like to get back very quickly to another extremely important story, which is, of course, the U.S. proposal for a global minimum tax rate of 15%. Yesterday, we've heard from Janet Yellen. She's really trying very hard about it. So far, we do see some headlines that Germany has welcomed the United States proposal for that, calls for corporations around the world to pay at least a 15% tax on their earnings. So we're once again back to this major story, but I was wondering, so do you see this global minimum tax, corporate tax of course, feasible? Because even the European Union, even the EU doesn't have a common fiscal policy.
No, it doesn't have a common fiscal policy. I think there's two things about it. Everyone recognizes that in the digital age, with so many companies doing business, e-business, we do need to find some way of getting around this. Secondly, we've had a race to the bottom, particularly countries like Ireland. And then we've got an additional problem of countries like the UK having just left the EU and wanting to have more jurisdiction over their end, whether they actually want to join in. And the fourth problem is the EU at the same time as welcoming this, and clearly that has a lot to do with big tech, and seeing more tax coming to the EU for a lot of the things which actually are paid in the EU. The EU itself is trying to get a collectivization of a lot of the tax on corporates and then redistribute it more evenly across the EU to take account for the fact that countries like Ireland and Hungary is much lower, have much lower corporate tax rates. So I think it's a great idea. I think it does need to be revisited. Whether it actually gets sufficient traction, particularly as there seems to be an element of voluntariness in this OECD proposal, and so to what extent if not everybody actually signs up, that's really where the big problem's going to be.
Well, that's pretty interesting. Do you think this is going to be positive or not? Because many people are arguing the opposite. I mean, that it's not going to be positive.
I think markets always take any form of tax rises as negative, but as we've seen with wealth taxes proposals in the past and hikes, it tends to blow over. I think in this particular case, the big risk here is that too many countries want to do this simply because they've increased their debt loads enormously and they need a bigger tax take. This is really the biggest challenge of the lot, that how much of this will people sign up because they're desperate to try and get their fiscal houses in better order after the enormous amounts of money which have been spent from the pandemic. Overall, I think for markets, it's probably not necessarily a positive.
All right. Thank you very much. Great to catch up with you. Marc Ostwald, Chief Economist, ADM Investor Services. Have a great weekend, Marc.
Thank you.